This is Fergus Hodgson, Director of Econ Americas and author of Financial Sovereignty for Canadians. We are offering a home here or source for financial sovereignty or finding your own financial freedom. And I'm so pleased to chat with someone I've been following for a long time. He is a senior policy analyst with the Frontier Centre for Public Policy, which is a think tank covering the prairies in Canada. And he's also a semi-retired portfolio manager with an immense amount of experience in the financial sector. He's been a grader of CFA Institute exams, and he's been heavily involved with the CFA Society. He's based in British Columbia. His name is Ian Madsen. You can follow him on LinkedIn. And I'm eager to have him just to give an overview of the Canadian context, the Canadian financial scenario, especially for Americans wanting to get involved. This is particularly relevant because Canada is home to, it probably is a majority of mining company headquarters, and especially in Vancouver, near where Ian lives. It's very much a mining hub. And a lot of these junior miners are listed on the Toronto Venture Exchange, and he's been especially interested in that over the years. So he's a wonderful guest for us. So Ian, mate, it's a pleasure to chat with you directly. And why don't you tell us? You mentioned before we started recording that you focus a lot on just the Canadian market and don't look beyond even Canada and rarely beyond North America. Why is it that you're so locally focused?
Well, it's mainly for personal tax reasons. In Canada, we have something called the dividend tax credit. It's kind of complicated the way it works on your tax return, but basically you do what they call grossing up your dividend income, apply your marginal tax rate to it, get a credit for that, and then apply it against your actual taxes owing. And the long and short of it is that you can make in most provinces of Canada up to about $85,000 a year in eligible dividend income, and not pay any taxes on it. So for taxable accounts, an ordinary margin or cash account, it makes a lot of sense to be almost entirely for Canadian in Canadian corporations. This does not apply to real estate investment trusts or some ETFs that behave sort of like REITs. And and because I'm almost retired now, I'm in the glide path to death, and the income I'm income oriented, so I'm not as capital gains oriented as I was in the past. In which case, I would probably invest more in some of the U.S. higher tech companies carefully that do not pay much in the way of dividends.
Do you want to back up that on that point though? Because does that mean you focus on dividend paying stocks over stocks that have capital gains in Canada? That there's really an advantage there to stocks that pay dividends?
Yes, and actually, coincidentally, those are the stocks that have done the best over the last 2 years. There are kind of themes which obtain in markets, that is, investing styles which pay off at various times. And one of them in the last a couple of years, since interest rates have leveled off and started to come down a little bit, dividend-paying stocks have done better since, in a crude sense, they performed a little bit like bonds, except they have a little bit of growth to them, which bonds do not, of course. Now, if you're looking at the Canadian markets, the Canadian market is dominated by mining, oil and gas, banks, insurance, and utilities. I think that covers over half the market. However, that doesn't mean you have to invest in those at all, let alone be have the equivalent of an index approach to investing in Canada, or be what they call a closet indexer. You don't have to have uh, 7% in of your portfolio in Royal Bank of Canada, for example. You could have 2 or 3 or nothing. There may be other banks that are more attractive than that. I recommend that in any sector, if you have the money, that you buy 2 or 3 companies in banking or insurance or oil and gas or utilities or so on. That way you eliminate non-systematic risk, as they call it in financial theory. That is, risks that are specific to a single security or a company. like some torpedo thing. For instance, if quantum computing takes off and really hammers NVIDIA, if you had 10 or 15% of your portfolio in NVIDIA, that might be what we call a torpedo that sinks you at least somewhat. That's just an example of what could happen.
For mining stock recommendations, one newsletter I read is Global Analyst by Adrian Day, and I'm more than pleased to direct other people to his insights. Receive a 10% discount when you subscribe with the FERG coupon code. Go to adriandayglobalanalyst.com and click subscribe at the top right. You can also call the US phone number 410-224-8885 and mention the FERG code. That is adriandayglobalanalyst.com. You can also click the link below or in the show notes. Thank you. Yeah, no, I mean, I agree with that rule of thumb that buying 2 or 3 in each area makes sense, and you don't have to follow the proportions of the broader Canadian markets. Now, I'm not sure how familiar you are with Mark Skousen, but he has a book called Investing in One Lesson, and he actually recommends, even if there were not the tax advantage, going for dividend paying stocks, just because it's such a healthy signal of a company or a robust or well managed company.
I agree with that. Yes, very much. For instance, there's this company in Canada I've liked for a long time, but the share price hasn't performed very well, called ATS, Automated Tooling. It's one of those interesting mid-sized Canadian companies that people don't think of as being in Canada, that is somewhat high tech, uh, automated equipment for packaging and assembling things, and but doesn't pay a dividend. And I think that may be part of the reason, not only the absence of the dividend itself, that the share price hasn't performed that well, but the management doesn't have the discipline of having to pay a dividend and usually slightly increasing each year, and being scared of cutting it and annoying investors if they have a downturn. That imposes a lot of disciplines and parameters and boundaries and hurdles that managers have to be conscious of, especially the chief financial officer, but also the CEO and the board.
Yeah, and you're not quiet about your concerns about, let's say, the evolution of Canada and the declining fiscal status. This is where you devote a lot of your research. Do you feel cornered by these tax advantages that lead you to invest almost exclusively in Canada?
Well, I sort of feel like I've been herded into that, but it hasn't been to my disadvantage. And as you noted from that author you cited, that there's something called dividend aristocrats, and it's something that started in the U.S., but there's also a version in Canada. You look for companies that have consistently paid a dividend for the last 20 or 30 or more years and increased it and never slashed it. And there aren't that many companies like that, but they've all performed quite well. But there's rebalancing of those every year. Some of them fall out of being in the highest rankings of dividend growth and dividend stability, and others come up. So it's always a dynamic thing. That's the thing about portfolio management, which individuals as well as institutional investors always need to keep in mind. You can't just buy a bunch of things and just let them sit and never look at them again. Warren Buffett has said something like that his ideal holding time is forever, but he admits a mistake and sells things that don't work out, such as airline stocks. He said if he could have, he would have gotten back in time and shot Orville Wright. So on the other hand, you shouldn't be fussing over things every day, although I admit that I do. I have to look at my stocks because I have several accounts I manage for my family. And there's always, well, not always, but there's often something going on that I have to address, if only rebalancing a little bit. When it comes to the Canadian market, if you want something that is kind of contrary to the way the US market moves, although they are mainly correlated. They have about 70 to 80% correlation. The part that isn't correlated is mining and oil and gas. And that's a big part of the Canadian market. So for an American investor, you could, if you have 50% of your money in U.S. indexes, you could put 5 to 10% in Canada, sort of an inflation hedge in a way, and also something that isn't completely correlated, so that you smooth out your overall risk for your total portfolio. And then you could add Europe and Asia and so on. Although I have one cautionary note. One thing the CFA Institute and some other financial observers do not put enough emphasis on is political risk and geopolitical risk. And I think there will be some sort of confrontation over Taiwan. I don't know what form it will take. But at that time, not only the Taiwanese stock market, but the South Korean and Japanese, and of course the Chinese stock markets in close proximity will also have problems. They will likely go down. So everyone needs to be conscious of that and put an upper limit on your exposure to those markets. I believe for the next 5 to 10 years. I think whatever happens with Taiwan will be resolved within that time. I'm not sure about that, but that's sort of an impression I have.
One other distinction that Canada has is that it's somewhat more decentralized in regulation on the provincial level. And you mentioned this was news to me, I did not realize, but there are three new markets that have popped up in recent years. Do you want to clarify what, let's say, evolution there is to the regulatory framework and the various individual stock markets that exist in Canada?
The regulatory framework is that there are 13 provincial and territorial securities commissions, and they review and approve securities issues that originate in each of those provinces. Now, the vast majority of securities issues occur on the Toronto Stock Exchange and the Toronto Venture Exchange, which is a shared jurisdiction with British Columbia, I believe, but I'm not completely clear on that. But there's a sort of a passport system that if an issue of an initial public offering or treasury shares or shares that are issued in conjunction with a takeover are uh, are reviewed by one provincial securities commission, then the others generally rubber stamp them. The Quebec and Alberta securities commissions have been kind of rather rebellious and not wanted to have a full national securities regulator. But in effect, there's sort of a council of provincial securities commissions which coordinates among the provincial and territorial commissions.
Yeah. Well, presumably the distinction there is that it's a voluntary compliance or voluntary participation regulation commission or grouping there. But what about why have there been three new exchanges formed?
I'll start with the Canadian Securities Exchange first. Uh, they saw an opportunity. They saw some complacency, and after the Vancouver Exchange, Venture Exchange, was taken over by Toronto, there was an impression, which may have been unfair, that it was now sort of Toronto centered and less amenable to the feisty little companies that were going public on previously on the Vancouver Exchange. There may have been some validity to that. Anyway, perhaps the results have proven that, because the Canadian Securities Exchange now has, I think, close to 1,000 listings, and they get new ones every year. And in contrast to what was formerly the Vancouver Exchange, they are not all resource oriented. There are quite a few IT things, specialty manufacturers, various kinds of retailers, food companies, and a bunch of other things. So it's an eclectic mix, and not as metal mining oriented as Vancouver was before it got taken over by Toronto. It tried to go one level above and not have the tiny little companies, but just smaller companies. And they've had some success, but they're still quite a bit smaller than the Canadian Securities Exchange. And there's the Alpha Exchange, which was set up mainly to facilitate trades between institutions and other large investors and large blocks of stock, which can become a problem if they try to trade them all at once on a stock exchange. They move the price one way or the other.
Right, and this is you're touching upon what has been my belief for a while, that actually whatever maybe negative sentiments we have about the trajectory of Canada, the financial sector has been relatively competitive and dynamic over the last couple of decades. So I actually hold the Canadian financial sector in relatively high regard. Now, and they were one sector that, just was pretty resilient during the COVID era. So now you mentioned they are resource oriented. That's a fact, and you have spent a great deal of time focused on the junior mining sector, which is heavily in Canada. Do you want to give a few just rules of thumb for people who are looking to dip their toe with this in this arena? Now, I also mentioned before the start that the Fraser Institute there in British Columbia has a ranking of jurisdictions for amenability towards mining. And still, I think either Utah or Nevada is number one, but the Canadian provinces are up there. So, do you remain optimistic about the mining sector being stable and lucrative or fruitful in the Canadian context?
Yes, with some caveats. I have to say that the provincial governments on the whole are not outright hostile or obstructive deliberately to mining companies. But over time, there have been these regulatory and super regulatory forces that have delayed things. Requirements for environmental analysis, consultation with property owners, and with First Nations people for that's our term for uh,
Aboriginal or American Indians, yeah.
Indian or Inuit in the far north people. And then there are other interveners too. Um, I think there are ways to have all these things be conducted in parallel and not in series to reduce the timelines because it's just outrageous. There was one mining company, well, it was a exploration company that has the largest rare earth deposit in the world, fairly high grade, and it also has a bonus of something called fluorspar. The company was Commerce Resources in northern Quebec. And they did all the things right. They kept proving up their reserves and everything. And I just gave up on it because what was limiting them in development was something that I ordinarily would not promote, is they didn't have a road built by the government to Tidewater on the north shore of Quebec. It was about 100 kilometer, no, 200 kilometer road, which would have cost around 100 million, which is chump change when you consider how important critical minerals are, which China has a lock on, and makes you wonder about the political leaders in Canada, in the U.S. They've known about this problem ever since China blocked the sale of rare earths to Japan in 2010 or 2011 over a territorial dispute over islands in the East China Sea, which is sort of a minor foretaste of what could happen with Taiwan as an aside. But I just gave up on Commerce Resources and sold out at slight loss, I guess.
The time between, I mean, the life cycle of a mine is incredibly long, right? Many people know this if they're familiar with the sector, that From the point of going out and exploring to actually getting things out of the ground can be 20 years or a very long time. So, and then the likelihood of actually getting there is low. So it's really, that's why you've got to get your hands dirty and really get into the research there.
Yeah, you have to investigate these things very well. Look at how the company has reached milestones. Obviously, most of these companies do not have any revenue, but how have they progressed to developing their reserves, getting on track with getting what's called a bankable feasibility study and so on. How they made progress, and is it steady progress? And how likely is it that they are going to make it to the stage of commercialization? And then when you get to commercialization, there's something that in the industry they call Death Valley, that you had all the hype of going from 1 cent to a dollar or whatever with the discovery, but then you start investing the money and removing the overburden, building the open pit, installing the mill, and so on, and the roads, and hiring the people, and that's a lot of money, and nothing happens, and then the share price tends to go down. So that can be quite a downer too. So you either want to invest at that very early stage when they're making discoveries and proving things up well, or later on when they're on the brink of production and actually bringing money in. Now, there's another way to invest in these things that is much lower risk, but the entities are highly valued. Things called royalty streaming companies, Franco Nevada or Wheaton Precious Metals. They what they do is they pay the mining companies to get a share of the sales of the eventual output of the mine, uh, and they do it in either dollars or in the actual ounces or kilograms that are produced. And so it's a low risk way, and they're highly diversified. Most of these companies have 30 or 40 or more different mines they invest in, which is a lot more than the mining companies do. But the dividend yields are rather low, but the share prices have performed very well, especially in the last year or so.
Well, that was one of my questions. So, do you remember the Bre-X scandal? Were you around during that time?
Yeah, and that had a rather positive after effect in that it caused the creation of National Instrument 43101, which made explicit. It always was implicit that uh, the owners and the top executives of a mining company have to guarantee that what they are stating in their news releases and in their financial statements is true, and that they had to have a qualified professional, geologist, professional engineer, or geophysicist sign off that this is correct, that these assay values of the drill cores are what we say they are, and also procedures to have them assayed by completely independent labs with no involvement by the mining company. They take the cores, they split them, they hide half the core away, and take the other half and do the assays, and they insert different blanks and things to try to fool the assayers, and as a double check. And so there are all kinds of safeguards now. So outright fraud is extremely rare now, and which has helped confidence in the industry. But that went into the 1990s when the gold price sank terribly. So it didn't do a lot for the industry, but it helped later on when gold prices started to recover.
So you're optimistic right now that the integrity of the markets has remained relatively strong.
Yeah, but the problem is that you can have a really good company. There was another company which actually was one of the ones that was mentioned by Prime Minister Mark Carney as being fast tracked through this new expedited review and promotion process in Ottawa. Foran Mining's McIlvany deposit on the border of Saskatchewan and Manitoba. It has very rich ore grades, polymetallic copper, and a whole bunch of other things. I invested in it for a while, but I gave up on that one too. And its share price is actually lower than when I sold it because It did well for me, and I actually made a total profit because I sold as it went up. But again, I got it got into this Death Valley situation where they were doing all the right things, and it was a very good deposit, but they kept having to issue shares to get more capital to invest in the company and develop the deposit and so on. So that's a problem with all these development companies. Now, another problem with these larger companies like Agnico Eagle and Barrick Gold and Newmont, the big one in the U.S. Uh, they have a lot of geopolitical risk.
They're invested all sorts of just really random, obscure places that, yeah, as you say.
For instance, Barrick is having a big fight with, I think, Mali and a couple of other Sahel countries in Africa where they have operations. And Mali basically sees the big mine there. First Quantum is in trouble in Panama. They're mainly copper, but they have some gold. And there's all kinds of things going on in Chile, which normally you think of as a stable place. But there's a strong undercurrent of leftism there that there is in many Latin American countries. And the socialists keep trying to take over and raise taxes and effectively expropriate.
Yeah, they're trying to nationalize. Yeah, yeah, and the cobre mine in Panama, that one has been basically, it was first blocked by all sorts of protesters or rioters or squatters, and then it's just been in delay, for the last year or two now. It's been stuck, and this is a common problem, like you said. That's why jurisdictional concerns are so important. Now, what do you think the streaming or royalty? Because you've got a few different options here, right? You can buy precious metals directly. You can, buy companies directly.
Oh, you can buy them. You can buy them on the stock market too as ETFs. So you don't have the problem of being worried about being robbed at home or whatever.
And you've got so many. There's such an array of options for getting involved with the mining sector or precious metals, and I do like the streaming or royalty companies. What do you think they've performed so well versus, say, the regular ETFs?
I think because they have great leverage to the gold price, and that's the main thing. And plus, their diversification.
It's much, much more directly correlated.
If the gold price goes up, let's say by 5%, well, that's good, or 10%. That's nice, but that really makes a difference when you're getting a royalty. It expands tremendously, and the mining company does well, but the royalty company does even better. And that's why the mining companies have finally started to do well this year. First, the large ones like Agnico Eagle and Barrick and Kinross and so on. Newmont, not quite as well. Newmont has a problem of being stodgy and being late. They're very well run, but they sometimes miss out on things, like getting uh, a company that has proven itself but it has not entered production yet. They do not get in early enough, aggressively enough. That's my impression of Newmont anyway. But who's to argue with their success? They've been around for over 100 years. So the mining companies have finally done well, and the mid-sized ones are starting to do well too. And as I watch the highs and lows every day on the stock market, a Trading View is a really good website, and it's free, and you can look at the highs and lows and the gainers and losers. A lot of these mining companies that I sold out of have finally started to do well, even though they are not much closer to commercial production. But it's helpful to them because now they can raise capital, they can issue shares at these higher prices without annoying their existing shareholders and diluting themselves too much. And they can use that cash and put it right into getting much closer to a bankable feasibility study, then getting they can get their equipment financed. And that's an important thing to consider. When you look at some of the capital investment plans of these companies, they look kind of horrific, like hundreds of millions of dollars. But a lot of that they can finance. They can get vendor financing or bank financing or institutional investor financing. from private equity or various hedge funds or specialty funds. So it isn't as bad as it looks when a company has a quarter billion or nearly $1 billion that they have to put in early to develop their discovery.
The key point about leverage, I want to just clarify that. Let's say the production costs $1,000 and the price of gold is 2,000, right? You're netting $1,000 per ounce. And let's say the price goes from 2,000 to 3,000, so you've got a 50% increase to the price of gold, but you've got a 100% increase to the actual profitability. That's the leverage there.
And now people are more confident. People weren't entirely sure that the gold price going over 3,000 or over 3,500, if that was temporary or it was just a fluctuation. But now it looks like it's going to stay relatively high, perhaps over 3,000. And these companies that were making good money at 2,000 or 2,500, they're just coining it. Unfortunately, some of them will now start paying much higher taxes and royalties. Uh, so they not only pay royalties to the royalty streaming companies, but they pay royalties to the provincial governments or state governments or federal governments in the U.S. or Latin America or wherever.
You know, I mean, we just touched on a few topics here with relation to Canada, and Ian is up in British Columbia. So, yeah, we'll continue to explore this at Econ Americas. My book was written for Canadians, and I want Econ Americas to target Americans and Canadians who are in this space looking to take responsibility for their own, let's say, self-directed portfolio management and financial independence. And there's so much more we could cover here. Ian is a wealth of knowledge. Now, Ian, if people want, you can follow him on LinkedIn. We'll have this all on the show notes at econamericas.substack.com. But are there any publications you mentioned TradingView that any other publications that you really enjoy on a day-to-day basis, especially if you want to look at these mining opportunities?
Well, I look at I'm a subscriber to the Globe and Mail and the National Post and the Wall Street Journal, and yeah.
For punishment or yeah, okay.
Well, I avoid the opinion stuff. Uh, uh, According to the climatistas, we should all be fried and drowned by now. And There's a publication I subscribed to for a short time. As I said, I'm no longer an active junior mine investor, but if you choose to do that, something called the Northern Miner is very good. And There are probably some other specialty things you could look into. There are a lot of newsletter writers based in Vancouver or Toronto or elsewhere in Canada who look at these little companies, and sometimes they're pretty sharp at what they uncover. I remember there was one young fellow who wrote a newsletter that was promoting a company called Juggernaut Resources when I went to the Vancouver Resources Investment Conference years ago, and it was trading around 3 cents a share, and I kind of rolled my eyes. But now it's several cents a share. I think it's in
Yeah,
dozens of
yeah.
cents a share, but that's an example of something where the company they had some merit. They had a good ore body which they worked on delineating and expanding, and the company is closer to whenever production might be. But that's an example of a higher quality company that I didn't fully appreciate at the time. And that's the kind of company you want to invest in. But Because these companies are so risky and so many of them don't exactly fail, although some of them do, but some of them just malinger and never go anywhere. You need to invest in dozens of them so that you will have, on average, 4 or 5 that do very well. And so that's tricky. You have to put a lot of time and patience into it. And the same thing is true with the smaller size oil and gas companies. But Canada isn't all resources. We have actually have some IT companies that have done quite well. People have probably heard of Shopify. There's a company called Constellation Software, and there are a bunch of other mid-sized companies that engage in a lot of business software as a service and specialty analytics, and now incorporating AI into what they do, that have done well and go under the radar. So Canada is more than resources, and I suggest you do some screening for various criteria, financial and operational, and look into some things that are not all financial or resource as well.
Yeah. Yeah, there's so much more to say about this, and I want to say thanks so much both to Ian and to all the listeners. If you have not already, please subscribe on Substack, econamericas.substack.com, and YouTube, just the Econ Americas channel. Ian, mate, it's a privilege to learn from you. Thanks for giving back to the next generation, and I look forward to next time.
Likewise, good talking to you, Fergus. Nice to see you again.